Welcome to No Nonsense. Once upon a time, there were two players on the stock market. There was the professional traders, who were the guys that actually sat on the trading floor and executed orders for stockbrokers' clients and traded for their own account. The other player was the investors, which were primarily retail investors like you and I. We put our orders into the stockbroker, which then relayed those orders to the trader on the stock exchange floor. Now, in the 1970s came the discount brokers, and what they did was allow a retail investor to actually communicate the order directly to the professional traders on the trading floor. And because they traded a lot, they didn't want to be called investors. They wanted to be called traders. And as a result, because of so much activity from these people, they created things like the dot-com bubble, or as the professional traders call it, the sucker money bubble. Now, we think of investors as being long-term in the market and traders being short-term in the market, and to a certain extent, that's true. Let me give you some examples. The movie studio is the investor because they're concerned about all of their movies over an extended period of time. Whereas the actor, he or she is only concerned about the movie that they're currently appearing in. A restaurant versus the customer. A casino versus me sitting at the poker table that's only concerned about winning the next hand. Now, the restaurant owner has to be concerned about menus. They have to think about suppliers. They have to think about costs. The diner is only concerned about that one plate of food that's being put in front of them. However, and this is important, the restaurateur also has to think about every individual meal that comes out of the kitchen. Now, there's a constant discussion between investors and traders as to which has the most sensible strategy. But I'm going to tell you, there's no battle. As far as I'm concerned, it's two sides of the same coin. What do I mean by that? The so-called long-term investor has to act like a trader. And the so-called short-term trader has to think like an investor. Why? Silly example. Fast food joints believed there was a trend they needed to jump on, plant-based burgers, until they discovered it was more or less of a fad, not a trend, and stopped promoting those burgers, and a lot of them dropped fake meat items from their menu. The 10 most consumed proteins in the world, that list is headed by pork. More pork is eaten around the globe than any other meat. However, chicken is the most widely consumed meat, and therefore, virtually every restaurant on the planet has chicken on their menu. Now, both investors and traders need to follow the trend. And you can only make money by following the trend in order to maximize profits and minimize risk. Now, what I want to do now is show you real world examples of thinking like an investor and acting like a trader. We have this general perception that there's only two ways to make money in the stock market. You can be an investor. Sit back, drink your 25-year-old scotch, and wait for the money to roll in. Or you can be a trader, which means you watch every trade, every fluctuation, and you're aggressive in your money making. By definition, an investor has a long-term strategy to building wealth over a long period, and the investor doesn't need to worry about downtrends.
as they only last for a short time. And you can see this Ayala Land chart from 2012, which was the bottom, to 2019, a trend. A trader, on the other hand, the strategy is short-term and volatile. It's a process that involves frequent transactions based on the trends of the market. Trading is dynamic and volatile and is a high-risk money-making process. You can see on this chart of Ayala Land, which is from March of this year, that the price varied between basically 20 pesos a share and 22 pesos a share, but this daily chart shows large swings, up, down, with relatively little sideways movement from day to day. Now let's look at the investing strategy. We start with 10,000, and from quarter one of 2012 to the end of 2019, buying and holding netted a 22,000 peso profit. That's pretty good. The account started with 10, and the total value at the end was 32. The price basically went from a little under 20 pesos a share to a little over 50 pesos a share. Now, the problem with a long-term buy and hold strategy is you really need to catch it at the right time. Getting in 2012 made perfect sense. Remember, we buy as the price is going up. And over that 7-year period, the price basically went up. But if you don't take your profit when the trend changes, you may wind up with the situation that we have now. The price of Ayala Land, very volatile, but also one directional since that 2019 high. And what we've done is we've made a full round turn. We're back to the 2013, 2014 price level. See, I believe that what we need to do is track the short-term trends in order to maximize profit. And that's why I say we need to think like an investor and act like a trader. And this is how you do it. Starting in 2012, 10,000 pesos. You ride the trend up, and when it reverses, you get out. Now, that doesn't mean you're going to get out exactly at the high, but you're not going to ride the trend down. So if you rode the 10,000 on a trend up to when the price reversed down and started a downward trend, your 10,000 would now be 22,000. That was about the first quarter of 2013. At some point, the price reversed trend, significantly reversed trend. See, you have to understand also that prices don't top out and start going down in an instant. Prices have to stop going up before they start going down. And by the same token, prices have to stop going down before they start going up. That's why I say we only buy when the market goes up. So at that period in 2013, at that time in 2013, when you sold out, the value of your account was now 22,000. So when the market starts going up again and it's confirmed, you put all of the 22,000 back into the market and ride the uptrend once again. The price peaked out in 2015 and started a downtrend, and it was confirmed. You sold out about a 35,000 peso value. When the market started the uptrend again in 2016, you put all of that 35,000 back on the table, ride it up again until the market stops going up, and take the value of your account at that time at about 45,000 pesos. Market goes down again, stops going down, put that 45 back in the market and ride it up to end of 2017, and the value of your account is over 62,000. Market goes down again, bottoms out, starts going up, put all that 62,000 back in and ride it up to near the top and the total ending value was 87,000 and about a little over 87,000. That's how you think like an investor, meaning that you are in it for the long term until the price definitely tops out. But in the meantime, you're going to get short-term tops and short-term bottoms, and this is how you take advantage of it. Here, look at the numbers. First quarter 2012 to second quarter 2013, your 10,000 has become 22. 14 to 15, you run up to 34,000, and then to 45, and then to 62, and then finally the value of your account is 87,000 for a profit of 77,000. Sure, you had to do a little bit of work, but if you had just sat on it until the market peaked, your profit would have been 22,000. Now, the other thing to remember is this chart is not a daily chart. This is a weekly chart, which means you didn't have to monitor every trade every day. Look at the price once a week. You see that it's topped out after a couple of weeks, and you've got plenty of time to get out with your profit and also to get back in so that you can ride the next wave up. Think like an investor. Act like a trader. Buy the uptrends to maximize profits and minimize risk.
Now do you see what I'm talking about? Two sides of the same coin. It doesn't matter whether you call yourself an investor or you identify as a trader or a bull elephant. The objective is exactly the same, and ultimately, at the end of the day, the way to reach that objective is pretty much the same also. Now, whether or not you're looking for big profits that require some attention, or whether you're looking for maybe smaller profits that don't require as much time and effort, it doesn't really matter. Look at it this way. It doesn't matter if you are an investor or a trader. What we are all here for is to be a profiteer. Remember that, because that's how you're going to get the most advantage from the stock market.